Welcome to the Boeing financial statement analysis video. This is our last discussion, and in this discussion you're going to take a look at Boeing and do the same ratios that you did for Lockheed. We use the exact same process and create the graphs and take a look at how they're performing. And when you get to the assignment, you'll see that a lot of the questions involve having you compare and contrast the two companies and make an opinion about whether or not you think one is stronger than the other, and then hopefully back that up with your analysis, with your results. So before we jump in and start running the numbers, let's just take a peek around and see how things look. If we go over to the balance sheet, we see same periods of time as you've studied in Lockheed Martin, which of course we want to get apples to apples. So we're looking at how the companies are doing in the same economic environments. We see the same sort of setup. We've got current assets, very similar types of items. You notice that contract assets are also part of their current asset section and that they ballooned in the last 2 years, which is very much in line with what we saw with Lockheed when we studied them. They didn't have any at all in the past, and then they had contract assets show up in the last 2 years. So very similar pattern, and that was a result of changes that were made in GAAP. So you see the same thing going on in the liability section, definitely a big increase from the previous 4 years to the last 2 years. Okay, and then another thing that kind of stands out in their balance sheet is this big hole they created in 2019. So my guess is it relates to aspects of the plane that they had crash, that large airline that they had all those significant problems with. There were many canceled orders and the whole plane was put on standby in terms of future production. And that really hurt them in 2019, severely crushed their financial result for the year. So one of the things you have to do in this assignment, when you get down towards the bottom of it, you'll see that I ask you to look for a couple of recent articles on the companies and see if you can find something interesting to share. So I think that would be something interesting to share. I'm sure there's current news as well. Things are crazy with the coronavirus. I'm sure you'll find all kinds of interesting articles to share with the class. But perhaps somebody could also go back and see what they could find related to 2019 that caused such a significant decrease in their financial performance. So if you wanted to dig in on this a little bit better, you can see that the area that really seems to be off the most of all these categories is retained earnings. And of course that must relate to profits. And if you look at the income statement, you can catch that. Look here, they have a loss for the year. And that loss, that's a huge decrease. This is $10 billion of profit, and now they have a $636 million loss in 2019. And it's primarily due to sales, which would indicate to me contracts that didn't get fulfilled that they normally have. So they really took a beating here on their sales, which trickled all the way down through and really just kind of destroyed them because they have a lot of fixed costs. A lot of costs they can't get rid of just because sales go away. And so the company is very sensitive to changes in sales patterns. If they have a drop in sales like this, they're going to show a quick loss. Also in the statement of cash flows, remember there's these 3 sections, and we've talked briefly about them. You're going to study them in more detail. Well, you probably already have. In the 3rd week, you look at the statement of cash flows, and you see this first section really took a bath. Right, so, and that's because of revenue. They didn't have the revenue. They had this huge loss to get out of. And then they cut back some in their property, plant, and equipment additions, and their, looks like, contributions to investments. They weren't able to put as much money away. They didn't make the acquisitions that they normally make where they're buying up other companies. So they cut back here some. But you don't see them really dovetailing their dividends or their cash repurchases of stock. So repurchasing of stock is something a company can do if they have extra cash and they want to buy back stock that's on the market. They often make that move when they want to improve shareholder returns, because what it does is it takes shares off the market. So the value of the company is still there, but they've removed some of the shares. So the existing shareholders benefit from the future potential of the company more than they did in the past. You're not sharing the wealth with as many people, essentially, is what's going on there. So you often see companies, large companies like this, engage in stock repurchases. And there's tons of reasons why they do it, but that's one of the most important. Dividends have held strong. They haven't backed off on their dividends. And that's very common as well, too. Even if you got a little blip like this, you might think, oh, they should be cutting their dividends. But when you cut dividends, you really make your stock price very volatile. So dividends is a huge piece of stockholder returns, and it's embedded in the stock price. So if you reduce your dividends, even slightly, your stock price is going to take a drop. It's going to decline. Mostly because that's embedded in the future value of that stock. So they're real careful not to tinker with that too much because they don't want to affect the stock price any more than it already has, given what's going on in the marketplace. The big change is right there where they borrowed a whole bunch more money. So they had to probably make this whole thing work, right? So that's a huge increase in the amount of debt that they had to retain to be able to make this work. So let's see how these things pan out in the financial statement ratios. Starting with the current ratio, remember that's current assets over current liabilities, all on the balance sheet. So type in equals, go to the balance sheet, click current assets, divide by current liabilities, hit enter, and woo, that's pretty low. Okay, so all right, much better back here on this end of things. We want to have this around 1.5 would be my preference. This is getting into dangerous territory where they're going to really struggle to pay their bills. They're going to have to probably tap a line of credit from the bank to be able to make their payments on time. If we look at the quick ratio, let's do it the same way we did it for Lockheed. We're just going to grab cash equivalents, and receivables. And I'm not going to grab the contract assets. I didn't grab them before, so I'm not going to grab them now. But you need to grab these first three. So this company, Boeing, has a category called short-term and other investments. You want that because it's liquid cash. Grab that and then divide by current liabilities. Oh my goodness. So low, right? This is going to be a real struggle. All right, now here we just grab the cash and cash equivalents. So I would grab the first two. And we'll probably have to put this in brackets. That to run. Oops. Okay, and that should have been a plus sign right there. There we go. Divide. Yeah, super low. Alright, then let's get this one. Hit the equal sign. Go to statement of cash flows. Yeah, we're going to be in the hole for that first one anyway. Divide by current liabilities. And that number you don't change because it actually is truly a negative result. Right? Don't flip that over. Alright, so serious liquidity issues, especially recently. So if we grab a hold of all of those and we go to insert and go to line graphs and we put that together, oof, it's not pretty. Whoops, sorry. Try that again. Grab onto the chart, slide it over here. Alright, let's right click on the chart, go to Save Data, and let's fix these up. So edit, that one's the current ratio. And this one, edit, quick, and this one, edit, cash, and this one, cash flow operating activities. And then edit these to the year. Okay, we're gaining. Let's put some data labels on them. Okay. Remember that this is structured from 2015 to 2019, so the trend is downward sloping. It's not a positive trend. We want this ratio to be hovering around 1.5 to be safe. These numbers are dangerously low, so it's a really poor liquidity position. Okay, let's keep going. We're going to look at, let me expand that just a bit. days sales outstanding, which remember is the number of days it takes to collect their receivables. So we'll do it the same way we did with Lockheed. Just look at accounts receivable, divide by, and we're going to go get sales on the income statement, which is right there, total sales. And then we divide by, type in average, and we're going to grab first these receivables, and then remember I did the contract assets as well. So then what you want to do is hit average these. Yeah. Okay, CD and CD, we got it. All right, let me make sure I got all my parentheses on. Okay, we need one more. Sorry, there should be a plus. There we go. No, it should not. Sorry. I gotta put my glasses on. Alright, so what we got here is 365 divided by sales divided by the average of the receivables and the average of the contract. Alright, let's give it a shot. Okay, that's fine. Alright, I needed a third one out there. I thought there was another one, but anyway. Hopefully you've got that. I'll leave that there if you want to pause it for a second to double check that and get that figured out. Go for it. Alright, if we pull that across, and I'm going to reformat these just like I did before and get rid of all those decimals. We don't need them. Look what's happening here. It's taking them longer and longer to collect the receivables. Not a good place to be. So my guess is that perhaps they're initially back here, their payment terms were 30 days. Now, either they've changed their payment terms to 60 days, which isn't out of the question, or they're having some real problems here collecting their money in a timely fashion. All right, let's do the inventory one. So this one is equals 365. Now we're going to go get cost of goods sold. So I think I should put my parentheses in. I'm going to go get cost of goods sold. We might have to flip the sign on that. Let's go see. Yep, we're going to flip the sign. That's all right. Divide average, and then let's go get our inventory. So that's right here. So you highlight the first two because you're averaging the beginning and the end of the year, just like we did before. I think we need another one. Yeah. Alright, so we got to change the sign on this because it's negative and we want it to be a positive number. But that's incredibly large. Okay. So it's taken almost a year for them to turn their inventory, which if you think about it, it's mostly aircrafts, which it takes a long time to make the inventory. So it doesn't surprise me, but I don't like this trend at all. Alright, so huge operating cycle. This is why they have so many liquidity problems. Okay, now let's take a look at the last one, which has to do with the receivables, the payables. So remember, what you did here is you added together the number of days in receivables and the number of days in inventory. However, you can't say that you got your cash tied up for this many days if you haven't paid for it yet. So we're going to calculate this and then subtract it from the 415 from this number to get the actual number of days that we got our money tied up in inventory and receivables. Okay, so again, we got to go get cost of goods sold. We'll come back later and fix the negative sign. Let's just get it run out. So there's cost of goods sold, divide by average. I'm going to go get accounts payable. Yeah, I know. On the end. There we go. And let's fix this negative right there. Okay, we got it. Alright, get rid of all those. And now we can take the 415 we have here and subtract 72. So that's really the number of days that we've got our money tied up in inventory and receivable. Still absolutely horrid. Alright, let's do what we did with Lockheed. We did the first two, we graphed that, and then I came back and got this one. So let's do that. Same idea. Okay. So this is asset. Boeing asset efficiency. and right click on the graph, go to select data. Let's get our data series looking good. So this first one, just type in DSO because I don't need all that information there. And then the second one, type it in as well, DSI, Days Sales Inventory. And then here, let's get our days. Very nice. Okay, let's add some data labels. So I just right click on the line, add data labels. Okay, then if you want to add another series, we can go to right click on the chart, and then this pops up, add. We're going to do DSP, and we're going to grab that line right there. Okay. Alright, so certainly the inventory, days in inventory is just out of control, right? They've had real problems going on in 2019 that they need to improve. But they started must be at the tail end of 2018. Problems must have started because they were fairly consistent across here, and then things really got out of control. That's a huge increase in the number of days, and that's really what's driving the problems here. Are these going up as well? Yeah. And this is going to offset, remember, because you're subtracting DSP from DSO. So they're going to kind of offset each other. But this huge increase in the slope here is really going to drive problems in your liquidity. So really what's behind this is increasing levels of inventory on hand. Okay, that's the big culprit. All right, very good. Let's look at our profitability. We know in 2019 it's not going to be pretty. Let's get our gross profit first. So that's this first profit number, which is sales minus cost of goods sold. So let's get that as a percentage. Okay, that's pretty low. It's like really terrible. Okay, so what that implies is because sales fell so much, the percentage of profitability there got slammed because they have an incredible fixed cost. You can imagine that Boeing can't unwind or unwrap a lot of the assets that they have in order to do business. They're a high-risk enterprise because of the cost of the investments they have to make. So when sales go south, they can't immediately get rid of assets and unwind their company, especially if they expect it to be a temporary problem. So let's look at operating margins, which is at this level. It's going to be negative, right, for the first year. Oh, yeah, so they lost money there. Okay, these were doing pretty well here. That's too bad. And let's look at net profit, which is the bottom profit number divided by the top. So every time we do a profit margin, we divide by sales. Okay, let's grab all three of these, get ourselves a nice plot going. It's not pretty. Yeah, that looks terrible. Alright, let me move that down and we'll dress it up. Okay, so this is Boeing profitability ratios. Okay, and let's right mouse click on that graph, select the data, go to edit for series 1 and grab gross profit margin. Go OK, and go to series 2, edit, grab operating profit margin. Go to series 3, edit, and grab net profit margin. Edit that and grab years. Okay, now let's add some data labels. Sorry, those shouldn't be there. I'll fix that on the template. Alright, so we got some profitability ratios here. They do not look very nice. Things are really heading south in that last year. I'm very interested to see what 2020 brings. Those results should be out in the first part of 2021. It takes about a total of 60 days is what they have to get their results published. Most of them hit that mark a little bit sooner than that. Okay, but they have to go through their year-end audit, and it's quite a process to get that all done and approved and audited and ready to go. All right, let's take a look at solvency. So remember, this is total liabilities over total assets. So total liabilities divided by total assets. Okay, not good. They have more liabilities. That means they have 106% liabilities to assets, more liabilities than assets. And they were running this really high, just like Lockheed Martin does, right? No surprise. Now let's look at the long-term debt ratio. Again, you're going to have to put in a formula here because there isn't a subtotal for long-term liabilities, but they're grouped. They're all right here. So I just want to add those together, and then I'll divide by total assets. There we go. Alright, so that's a little bit better. Okay, and that bump isn't too bad. Let's go back and look at that again. Alright, so they do have more long-term debt here than they had. They had more long-term debt, but it wasn't a significant increase overall. 9,000. But remember, back in the statement of cash flows, they showed $25,000 increase. My guess is they took some of that and paid off old borrowings and kind of refinanced. Maybe something came due, and so they had to refinance it, and they took out a little extra money to help support their cash flow situation. And some of those new borrowings might have been in the short-term category as well. Right? There's current maturities of long-term debt. So that loan they took out is a real short-term loan, which I'm sure that's how they sold it too. It's a short-term problem. We're going to get over this hump. Okay, so now the debt-equity ratio, remember, is total liabilities over total equity, which is a ratio that I don't often use. I like using the debt ratio and the long-term debt ratio. I just think, given the situation that we have in the marketplace today with how much leverage companies use, these numbers just look ridiculous, right? They're not terribly useful to study. Essentially, that means that debt is several thousands of times larger than your equity. And I'd just rather see it this way relative to assets, and it's more proportional. It makes more sense to us humans, right? When we get into these great big huge percentages, we're not used to seeing that, whereas we're used to seeing things like this. Okay, times interest earned is the earnings before interest and profit and taxes, divided by interest expense. So you go over here, that is really your operating income. All right, here's your interest and other debt expense. Now I don't want to change the numerator because it is in fact of a negative profitability and we want that reflected. I am going to change the denominator because I don't want it to be negative normally. I want it to show me the times that this is over the amount that I owe. All right, so let's set this up. I'm going to divide. I'm going to put in a minus sign and hit that right there. And that should do it. And I want that as a number, so I'll get rid of those decimals and shrink it down to one decimal place. That's perfect. All right, so we used to have $25 of profit for every $1 in interest. Now we don't have any profit. We have negative $2.70 for every $1 we owe in interest. These are horrible. All right, so I think we did the first two. We graphed for Lockheed. Because like I said, that third one, it just doesn't make any sense. So we'll do that. That's your solvency ratios. I'll put them right here. And clean them up a little bit. Right click, select data, edit. Series 1 is the debt ratio. And Series 2 is long-term debt ratio. And you can edit your years. Let's clean up our title. And add some data labels. You know, you can move those data labels too if you find that it's too hard to read them on the line like that. So you can have them above, which I think actually looks a whole lot better, right? Let's see if we can get these. Yeah, it's just so much better. If you want to go do that to the rest of them, I think it really helps see the numbers because they get kind of buried in the line. Anyway, that looks good. Now remember we did times interest earned before, and we did a bar chart, so let's do that again. There it is. That's the one we want. Okay, let me clean this up right here. This is times, we'll probably better put the name to be consistent. Alright, we can add a trend line through that. Try that again. If you right click on one of the bars, it'll do it. Okay. And let's select data, get this so it's years. Alright, that looks fine. You can definitely see there's a problem here. Okay. So put that someplace over here, right? Okay, that's it for those particular ratios. Let's look at sales growth and asset growth, net earnings growth, and see what's going on there, because that's going to help us pick out that sales problem. So you take total revenue minus the previous year, and you divide it by the previous year. Same thing I did the last time. Let's try that again. My apologies. I'm not even on the right cell. Let's try again. Equals this minus this, and you're going to divide by this, and we'll put our parentheses on here. So make sure we do that, because otherwise it doesn't follow the right order of operations. So we took sales from 2019, we subtracted sales from 2018, we divided by sales for 2018. That's exactly right. So you had a 24% decrease in sales from 18 to 19. Okay, there was a slight, tiny little dip in sales there, and there was a slight dip in sales here. This is catastrophic for them. Alright, let's do the same thing with assets, see if I can do a better job this time. Okay, you're going to take the assets here, minus the assets here, close your parentheses, hit divide, and the assets here. Hey, we got it. Okay, so they still grew their assets. They didn't grow them at the rate they grew here, but they grew their assets. Okay, earnings growth, that's going to do the bottom line here, so it's net income. Okay. So that's this number minus this number. Close the parentheses, hit divide, this number. And that should be a percent, so change that. You can take it out once, that's consistent with the others. Yeah, what a mess. And then earnings before tax growth. So we did this one especially for Lockheed because they had that tax bump. But let's do it here too. So we got apples to apples. Change that to a percent, 1 decimal. Alright, I'm not sure I had you do that in the other one. I can't remember. For some reason I think maybe I forgot. But we really should do a line graph for all of those too. Oh yeah, that looks cool. Okay, so these are sales, asset, and profit growth. And we should right click, select data, and let's fix up all these names. So this was sales growth. And this was asset growth. Let's edit these. Okay, let's select the data, and I just want to add data labels. Sorry. And again, if those are crowded and you think it looks a little messy, by all means you can move those so they're all above the lines, and I think that would clean up a lot of that mess. Anyways, you can certainly see that there's a huge problem in the way that earnings are responding, as well as sales and asset growth. So companies certainly experienced some troubles in 2019, and again, when you go to look for some articles, if you could try to figure out what's going on there, see if you could find some explanations for some of the troubles that they had. I think I have a pretty good idea, and I talked about it earlier, but it'd be good to have some proof of what's going on for the company. You could also read the front end of their annual report. If you wanted to Google Boeing's annual report, you could do that. And I'm sure they talk about what the issues are and what the risks are and what they expect to happen and their forward-looking thoughts about it. So financial statement analysis is a lot of fun to do. It's kind of like puzzle solving, and you get to look and see what's going on with the company over time and how all this accounting information comes together, how investors use it, how it triggers more information. Like, you kind of get an idea of what's going on, and it just makes you ask better questions. And that's what data analytics is all about, right? Getting better data to help you make good decisions that are going to have an impact, the highest impact as possible on your company to improve things for them. Okay. So that's it for now. If you could post your discussion board, you're going to be focusing mostly on which company is doing better, and I think it's a pretty clear answer on most of these, but it'll still be good for you to go through and kind of articulate that in your own words. And then at the end, I ask you to go look for that article, so that'll be good too. And I look forward to your post. I look forward to reading it. And that's all for now. Let me know if you have any questions.